I need to do one thing.
Okay. I'll give you a little intro while you're doing that. So if you guys are curious, Becca, against her will, basically, was asked to share some of what she knows once a month in the form of a little class like this. And I think our first one was last month, and she did the 1 to 4 family contract. Today, she's going to do third-party financing, addendum. And what was the other one?
Addendum concerning right to terminate.
Yes, addendum concerning right to terminate. So our hope is that by providing outlets like this for you guys to better understand the documents that are used often, also provide just a regular rotation of more of the nuts and bolts when it comes to the transaction. So we're going to start doing this once a month, and she's going to go ahead and get started. This is being recorded. I'm going to move it to the archive where all of the other class recordings live in property base so that you can always access it later on. But with that said, take it away, Becca.
Okay. Jim, you will probably know this information, but you're here, so.
I'm just here, I want to review it and catch up on the newest.
Yes, we're gonna do third party and addendum. What is it? This one's pretty. I'm just gonna sit down.
Yes, go for it.
Wait for Brittany so she doesn't miss it.
Okay.
I haven't eaten today.
All good.
We snack all day.
Yeah.
I'm a grazer. Okay, so we're gonna start with the third-party financing. I know you weren't here whenever we went over the contract, but we can do that at any time.
Okay.
So I like to do things in my order, and my brain's like a book. Like when I send documents out to a client, like I like it to go in order. So that's how I think I'm gonna teach. So the next, in my view, my brain, the next document that comes in line is your third-party financing addendum. This is going to apply whenever you're typing up your contract and you select the box for the price, third-party financing on your 1 to 4 family contract. So then you add this addendum, and that ties this addendum as part of your 1 to 4 family contract.
Okay.
And that's what you'll use this for, and you have this if you guys want to make notes. So the first line that we have is the type of financing that you have, and you're going to select A through F. Personally, I've ever come across conventional, FHA, VA, and USDA, but we're going to touch on conventional, VA, and FHA loans. So box number 1 is A, and then the first one is going to be the first mortgage. The first line item that goes in there is going to be your sales price minus your down payment amount. Sometimes people put in the full sales price amount, but this is what the actual loan amount is, what they're actually financing. Sales price minus your down payment goes in box or in line item 1 under the conventional financing. The next line, and of course you want to, if you're unsure about any of these terms, you want to ask your lender or their lender that they are using as far as their interest rate in the terms. Conventional is going to be a 15 or a 30-year loan, and box in line item number 2. And then the next one says interest not to exceed blank amount. Your seller, if you have representing the seller, is probably going to want, I mean, I've never really had a seller ask this, but they could, a seller might want the interest rate not to exceed a higher amount. The seller is going to want it to be a lower amount. So if you put in there, and I'm giving a really arbitrary number, if you put in 10%, so that means of the course of the loan, if they didn't lock in, I mean, not the course of their loan, when they're under contract, if they didn't lock in their rate, the seller wants it higher. And so if they were quoted like 2.5%, and then they actually lock in their rate at 2.9 or 3%, well, the seller, like it didn't exceed that amount, the buyer was going to want it lower, because not that they're ever looking for an out, but say you put in 1% and they actually lock in at 2, they could use it and say, hey, this is not the agreed upon terms, I'm going to terminate. So you want to try and make that as fitting for whoever you represent, but you're gonna put that interest rate in the second year. And then your origination charges, again, are gonna be based on whatever your lender says, and make sure it's someone you know, like, and trust for whoever they're using for their lender amount, and that's the origination charges. And again, that's gonna be based off their closing fees with their lender or financial institution that they are using. Your FHA insured financing section is gonna be, you're gonna get the loan type for the lender. Normally, for an FHA loan, it's gonna be 203B, but there are different FHA loan types. But again, you'll find that information out from their lender. And the sales or the financing type is the same. It's gonna be your sales price minus the down payment. It's gonna be the finance price for how many years, and the same information is gonna be in there for their origination charges and their per interest rate amount based on their loan. On VA, again, it's gonna be a little bit of the redundant information, but if you are accepting a VA loan, whether you have a seller or a buyer, you typically want to make sure that they have already received their certificate of eligibility. It takes a few weeks to receive that. So if you're on the seller side and you receive a VA loan or an offer that is VA, you want to request that they already have that certificate of eligibility. You don't want to get them under contract and be trucking along and then they get denied in the process for that amount. And then either that buyer, typically with VA, you're doing no money down. So if they can't switch their loan type because they don't have the money for a down payment for conventional or FHA, you can be back to square one and terminating. And that, again, the same things apply if you're representing the buyer. You don't want to be under contract thinking that you're working on a deal to get it closed and funded, and then it turns out they're not really qualified. So if you have a VA buyer and you're working with that lender, make sure they have that certificate of eligibility before you really kind of move forward, because for various reasons, they might not qualify for that. The next on paragraph 2, where it talks about approval of financing, it says the approval for the financing described above will be deemed to have been obtained when the buyer approval and property approval are obtained. Time is of the essence for this paragraph, in strict compliance with the time for performance is required. You normally, if you have someone that has financing for conventional or FHA or VA USDA, you want to put in an appropriate amount of days for your buyer to obtain buyer approval. This means, like, are they qualified for the loan themselves? You want to allow them to give them as much time as they can to get all of their documents turned into lending. It's not going to be 5 days. And even if they turn them in and they're ready to go on day one, the lending process, it takes time to get it into underwriting, to actually get them approved, to get all of their documents verified. And this is a protection for your buyer. You typically want to do 21 days or greater. Obviously, it's going to be market specific. You don't want something to be so long where the seller feels uncomfortable that they basically can terminate at any time if you want to extend it out to the life of the contract. But it needs to be appropriate. So like I know Brittany explained your situation with a maybe possibly contingent situation. If you're going to have a longer close date, like a 60-day close date, you might want to do 35 or 40 days. If you're thinking, hey, this deal is probably going to close in 30 days, you want it to be appropriate and do 15 or 21. So not every contract is going to be the same, and every time you do a deal, they're all going to be slightly different, because not every borrower or not every seller are going to be under the same, I guess, conditions of buying or selling a property. So get to know your client and get to know the circumstances of them purchasing or selling their home. Whenever they're under buyer approval, the mortgage is determining their debt to income ratio, all of their W-2s, are they being paid correctly? In our area, we have like contractors or different plants are going to verify all of their income, and that's why this paragraph is very important. Sometimes people will check the box and forget to put the amount of days marked in there. And if they get into a contract and they're right past their option period and then underwriting says, hey, like this doesn't match up, they lose their earnest money. Yeah, they can terminate, but this protects them and allows them additional time to terminate the contract and receive their earnest money back. So make sure it's an appropriate amount of days. That's sometimes kind of overlooked. The next box under buyer approval is going to be box 2, where it says on the second page, where the contract is not subject to obtaining buyer approval. This box typically means, like, say you have someone who is an investor or a business owner or whatever, someone that has the cash to bring to the table, but they don't want to use it. They want to see if they can do financing. But hey, if financing falls through, that's not a problem. I don't need financing approval. I have the cash if I can't get a financing deal for whatever reason. I've personally never used that box. I'm not saying that people haven't used that box, but that's typically what that box is used for. They're trying to secure a loan, but they don't have to have that loan. So be very conscientious if you're going to check that box. So if financing falls through, again, they can terminate, but they're probably going to lose their earnest money. Paragraph B is property approval. It says if the buyer's lender determines that the property does not satisfy the lender's underwriting requirements for the loan, including but not limited to appraisal, insurability, and lender required repairs, the buyer, no later than 3 days before closing, may terminate this contract by giving the seller the notice of termination and a copy of a written statement from the lender setting forth reasons for the lender's determination. If the buyer terminates under this paragraph, the earnest money will be refunded to the buyer. If the buyer does not terminate under this paragraph, property approval is deemed to have been obtained. So there's difference between a buyer being qualified for a loan and a property being qualified for a loan. So FHA buyers, not only do you have to qualify for the loan, meaning like your income and your debt, things like that, but your property also has to qualify. For an FHA loan, like you can't have peeling paint, rotted wood, incomplete flooring, the roof can't be shot, things like that. So if you're going through inspections and it somehow slips or the appraisal comes in and says, hey, there's a foundation problem, or I don't know, a water leak happened and they ripped up all the flooring. So your property also has to meet approval for some of your loan types on here. Or say, obviously with a loan, say the insurance company won't approve it for whatever reason. Well, a mortgage company isn't going to give you loan approval if they can't insure it with the insurance company. So there's a lot of factors that goes into that with property approval. The buyer is so it's the buyer's lender is determining if the property satisfies their underwriting requirements for this property approval. So it's not, now we're moving past, is the buyer qualified? Now we're moving if the property also qualifies. And again, it's dependent on their loan type.
Isn't VA even tougher than FHA?
In my opinion, yes. Like I had recently a VA seller, and just like, I mean, thankfully it was good that, the appraisal is going to go in and check a little bit more stringent things than what a conventional or FHA appraisal is. And sometimes, unfortunately, sellers don't want to accept a VA offer because of that, but it's just going to be, that's me, dependent on that loan type.
We personally did a VA loan on some property and it was a disaster.
As the buyer,
Lots of red tape.
It was horrible.
and then the seller gets discouraged and thinking, I don't want to do this again. And I have some sellers right now that they were FHA buyers on their last property, and it was a struggle for them as the buyer. So when we go to sell their house, they were like, not that their house won't qualify for FHA, they're like, we don't want to do this. Like, I don't want an FHA buyer. And they were the buyers that got, not that they got burned, but it took them forever to close on a house. And it was just a nightmare for them. And so they don't want to do it again. But
In the event you see in the listing, it says cash conventional and does not say FHA or VA. Is that a red flag maybe? Because either they don't want to deal with that, or there's they know there's issues with the house, it won't need FHA approval. or
But,
VA approval.
Yeah, and I've had like it was Christy and I were upstairs, we were talking about it yesterday. Sometimes it's maybe not anything wrong with the property, it's the seller that doesn't want to have to deal with the VA or an FHA appraisal coming through or inspections or anything like that. And whenever I had a listing, they didn't want to do VA just because they were so afraid that the appraisal was going to come in lower on their property. And, they don't want to deal with it, or sometimes conventional can be a little easier. But I mean, we've had lenders and appraisers come in that says that they're kind of checking all the same things, whether it's conventional, VA, or FHA. I don't know. They say it's the same, but when you're actually in practice, you're like, I don't know, my conventional ones are always a little bit easier. You just don't ever know. But they have, VA is going to be no money down. FHA is 3.5%. And then conventional can be as low as that depending on what program that's out, but you're typically looking at 5%. And some people just don't have
The 5%.
the 5% down.
For a while, there was some things like it was 10 or 20% down. Has that gone away?
For conventional ones,
Yeah.
I have people who have put that down because they just have the cash to do so, but not because it's requirements. All the most common conventional ones I've seen have been 5%, but you're right. Like when I had first got started, like conventional loans were like 10 to 15% or 20%, and so everyone was doing FHA loans because it was 3.5%. And then now I'm thinking that 1.5% difference, some people are just switching to conventional loans. But you're right. I think it's kind of changed, but I'm not the lender. Maybe we can ask Eric one day.
Maybe.
Okay, so your FHA VA required provision on paragraph 4 says if the financing described above involves FHA insured or VA financing, it is expressly agreed, notwithstanding any other provision of this contract, the purchaser, which is the buyer, shall not be obligated to complete the purchase of the property contract if the purchase of the property contract described herein to occur any penalty or forfeiture of earnest money deposits otherwise, unless the buyer has given in accordance with the HUD FHA or VA requirements a written statement entered by the Federal Housing Commission Department. So this paragraph is talking about it's got to appraise for a certain amount. How I have been taught for VA and FHA, you want to put in the sales price of this amount. So this is not the sales price minus the down payment. Your buyer is going in saying, like, if I put in my offer amount for $100,000, that they want their appraised amount to come in at what they're purchasing it for, not their financed amount, but what they're offering for the full sales price of the contract. And then the very bottom paragraph, it says authorization to release information whenever you're signing as buyer or seller. Paragraph A under paragraph 5 says the buyer authorizes the lender to furnish to the seller or the buyer or their representatives information relating to the status of approval for financing. So if you have a seller, it's perfectly fine to also reach out to the lender, and you obviously they're not going to release proprietary confidential information, but you are authorizing them to get status approval for financing. So sometimes people are like, oh my gosh, as a seller, you have a buyer. Why did your client or why did the other agent reach out to the lender? Well, you agreed to it in your third party financing agreement, and it's totally okay to reach out to the lender to get updates. And sometimes the lender, whenever you submit to the contract, submit the contract to the lender, sometimes the lender will send status information to both parties. Right now I have a deal going on with another agent in the office, and anytime we get a status update, that lender sends it to me and the other agent. Now, it's not confidential information, but it's just status information about the loan process, where we are with the appraisal, where we are with them. Hey, you guys are conditionally approved right now. It's just kind of blanket, non-confidential information that lets both parties know the loan process is in progress, which is totally fine. Do you have any questions?
Yes.
This one.
Hold on, wait. Go back to this part.
Mhm.
The first, how many years? What was this?
So this one is gonna be the same thing. It says for your interest rate not to exceed X amount of years. So this is gonna be, do they have an adjustable rate?
Gotcha.
So if you're gonna, again, ask the lender if their interest rate is set for the first 5 years, the whole life of the loan, 30 years. And again, you'll get that information from the lender if there's an adjustable rate or if they have a set rate for the entire term.
Gotcha, okay.
Does anybody still own houses on, or loans, what we call it Addendum? In 83, when we bought our house, our interest rate, deal was our interest rate for 15-year loan.
Mhm.
We pay X% the first year, the next year it goes up like 0.5%. The next year, for 5 years, it goes up a fixed amount. And then for the final 10 years, the interest rate is fixed.
At a lower rate or it was increasing?
It increased for 5 years, and then after the 5th year it was fixed for the life of the loan. It's not like an adjustable that fluctuates with the market. This was a fixed amount and then fixed for the final 10.
And there was,
I don't know if
Someone-
anybody's, haven't heard of that.
I haven't either. And then there was somebody else that recently, oh my gosh, they paid X amount of dollars more down to like buy the percent down, like a half a
Points?
percent. Yes.
Yeah.
They were buying points to get their rate down because they were putting, so I don't know if that was for the life of the loan or for the first X amount of years.
My husband does that a lot. He's got a lender, their lender does that.
Well, they'll-
DHI mortgage.
Yeah.
They'll allow them to buy points and it's like 1% of the sales price or for the finance.
The financed
The
amount.
financed amount. It's 1% of the financed amount.
Yeah, and it'll drop it.
And it drops their points, but then that's more money that they have to bring to the table at closing because that's cash at close.
And it's
So,
expensive. It's not like chump change.
yeah,
No, and ours, we had, I forget what we were required to put down. And we put that amount down, and then, like I said, we were jumping up a little bit for 5 years.
Well, I haven't seen, usually in my experience now, I guess it's the most common ones that I see are conventional loans, and it's usually a set interest rate for the life of the loan. And
Yep.
then because a lot of our agents are talking about refinancing, because when they bought 2 or 3, 5 years ago, their rates were higher,
yeah.
and so their interest rate was set for the life of the loan, and now they're refinancing for another lower rate, but set rate for another lower rate for the life of the loan.
My son did a refi on his house in Pearland, and they were only there for not quite 4 years. And after 2 years, they refinanced, and because of the rates had dropped, they were saving like $500-600 a month.
Yeah,
Yeah,
Mhm.
we did the same.
just
With our,
recently.
no, with our old house that we had, we didn't anticipate the move here to Beaumont. So right before we got the news that we had to move, we had just refinanced our house. So, kind of sucked, but
Yay! Did you guys sell it?
yeah, we sold it.
Oh,
I think they were only in their house in Pearland about 6 months before they ended up selling it. and
after they
moving out of
refinance
state.
it?
Yeah, and then even moved out of state.
Oh, man. You're like,
Yeah,
you save that money for a few months.
exactly. Not even that, but just you have to come up with another down payment when you
Yes.
refinance too.
Yes.
So it's like, well, here we are.
And then another down payment when you want to buy where you moved.
Exactly. Yep.
Well, they made enough, they bought at 185 and sold at 240
Oh, wow.
after 4 years.
Yeah.
So they came out okay.
Yeah, we did too. We did really well.
You're like, yeah, I'm gonna sell high and I'm gonna buy expensive.
And they lucked out, they didn't move to California. But they're in the Mojave Desert where nobody wants to be.
Oh, I was like, wait, hold on, because
Yeah.
now they're gonna spend $1 million for like a
There-
1,000 square foot.
They're in about 1,200, no, I think 1,400 square feet, and they only paid like about 180.
Oh, wow.
They got in for around $120 a square foot
That's
Wow.
not bad.
on an existing house.
That's like
Yeah.
here, but
Mhm.
California.
I know.
Of course, you're almost 2 hours east of Bakersfield. You're an hour and a half west of Barstow. You're an hour and a half north of Lancaster and Palmdale. So you're literally in the middle of nowhere.
Mhm. I wonder what the landscaping, is it literally just desert?
Probably just like desert landscaping, like the lava rocks,
There-
and some cactuses.
Their front yard is, granite rocks about that big.
Yeah. I would hate that. I gotta have trees.
Well, they planted a couple trees.
Are they alive still?
I hate trees.
I love trees. I love trees. I
Not
want the
me.
big oaks and
Oh,
maybe
we have,
not pine.
we have two that we're about to chop down.
Are you serious? Oh my gosh.
Hate them.
Oh,
I've got a couple of small oaks growing in my pot in my backyard. If you know anybody that wants them.
no. I'm like,
You're like, I don't know if we'll be here 30 years to see that big tree grow.
yeah.
Okay, our next form is the addendum concerning right to terminate due to lender's appraisal. Now, this is probably me being a little OCD, but we're gonna read it twice because it's on there twice. And you'd be surprised how many times I see this form used whenever again, I read it like a book, 1 to 4, third party addendum. So when I'm uploading files for agents, I already know and I'm thinking chapter number 2 on the third party, it's conventional, great. Then I'll see FHA or VA, and then I see this, and I'm like, why? So we're gonna read it, I'm gonna read it. It says, use only if the third party financing addendum is attached to the contract and the transaction does not involve FHA insured or VA guaranteed financing. And then the next line is you put in your address and the city. And then again, the financing described in the third party financing addendum attached to the contract for the sale of the above referenced property does not involve FHA or VA financing. I don't know why, but people will use this even though they have, yes, on a non-conventional loan, because that appraisal provision is already built into your third party financing. And it says it twice, don't use this if you have an FHA or VA loan. So this is only going to be used really for your conventional loans, and this gives them the right to terminate due to the lender's appraisal. Box 1 is a complete waiver. It says the buyer waives the buyer's right to terminate the contract under paragraph 2B of the third party financing addendum if the property approval is not obtained because of the opinion of value in the appraisal does not satisfy the lender's underwriting requirements. So that they're saying I'm checking box 1, that I'm waiving my right to terminate regardless of what the appraised value comes in at, period. They're saying, look, it doesn't matter. I'm going to bring up the cash difference.
So you're hardly ever gonna check that box.
Yes, and if you do, you need to make sure that you and your client fully understands what that means when they say, I'm waiving the right to terminate regardless of the opinion of value if the appraisal does not satisfy their underwriting requirements. I'm making up that difference completely. So make sure that whatever number is thrown out there, if they put $100,000 offer and it comes in at 50 grand. So this is not, oh, I think it may just underappraised by a few thousand. They're taking that risk of whatever number is thrown out, they're making up that difference between the appraised value and their contracted value. So again, if you're in a bidding situation and you're like, you know what, it doesn't matter what the appraisal is going to come out, we're going to put in the highest offer of 150 that's only listed for 100,000 and then it still appraises for only 80. They're still paying the contracted value, not the list price, their contracted value plus the underappraised amount, that entire difference. So be very, very smart when checking box number 1.
Okay.
Box number 2, a partial waiver. The buyer waives the right to terminate under this contract under paragraph 2B of the third party financing addendum if the property approval is not obtained because the opinion of value does not satisfy the underwriting requirements and the opinion of value is blank or more. So reading this for the longest time, I was like, oh, this doesn't even make any type of sense. So what this means is say if your sales price is $100,000 and the buyer has, say they're doing a conventional loan, which is 5% down, they're going to put $5,000, but they also have an additional $30,000 of cash, just sitting in the bank, and they want to do a partial waiver. They're like, look, I'm putting in an offer at $100,000 and I'm putting down my $5,000 for my regular down payment, I have an additional 30 sitting in the bank. So if it appraises for $90,000 at a minimum, I'll still take the house and I'll make up the difference. Meaning, so if it appraised for their minimum amount, because they have the cash to bring up the difference, then they're willing to make it up. Not if it appraised for $89,999, that means that they can walk. So if it appraised for $80,000, but their minimum amount there was $90,000, they can still walk and the earnest money would be refunded to them because it was less than their agreed upon amount. So I'll meet you in the middle and I'll pay the difference if it doesn't at least mean this minimum standard or this minimum amount of value that I'm willing to accept and make up that difference. So if they have $15,000 left in the bank and they put $5,000 down, they only have an extra $10,000 to play with. You don't want to exceed that amount less the cash that they have in the bank because they can't make up the difference. So that's your partial waiver. It's put in the amount that the minimum amount minus whatever cash they have, if they're willing to make up that difference, goes in partial waiver box number 2. Box number 3 is what is most commonly used in our area right now, the additional right to terminate. In addition to the buyer's right to terminate under paragraph 2B of the third party financing addendum, the buyer may terminate the contract within X amount of days after the effective date. This is really important to know your specific market and where you're at. Talk to your lender, multiple lenders if you have to, and say, hey, what are you seeing for turnaround time for appraisals to come in? Right now, example, I just closed in 30 days. It was totally normal, wasn't behind on anything. Got a contract in, it's executed. We just got an email that said the normal appraisal at $600 is going to be we've got it approved with AMC, which is the appraisal management company. It's 6-week turnaround. Our contract was a normal 35-day contract, and the appraisal's not even coming in for 6 weeks. Hey, but they'll pick it up in 4.5 weeks if we do the rush and bump it up to $850. My clients chose to do the rush because they don't want to wait a minimum of 6 weeks for it to get picked up or due in time. And then of course the appraisal will take another couple of days to a week to get it turned back in. So they chose for the rush. So you need to be aware of your market and appraisal timelines and turnaround. So obviously as a seller, you want as least days as you can as possible. As a buyer, you want as many days as possible. And again, as you're writing your contract, if you're going to put a 6 or 8 week timeline on there for whatever reason, make sure you don't want to put 20 days because your lender is not going to order an appraisal 20 days in if you have a 8-week timeline for your contract. Now, some people automatically, a previous one that I just did, they automatically told their lender because they were afraid of a long appraisal turnaround. As soon as we got under contract, they told their lender, go ahead and order the appraisal. I think we were still in our inspection period, but they wanted it already on the books. They wanted this house so bad. This was the only house that they wanted. They weren't interested in anything else. And if they weren't going to buy it, they weren't moving. The only reason they sold their house is because they wanted this one particular property. And so all parties knew if it falls through, we're pulling our house off the market. So again, they, in that example, immediately said, tell the lender to order the appraisal. We're going to pay for it either way. And they had the money to know that, hey, for whatever reason, if it under appraised or the inspections fell through, they were willing to still pay that appraisal fee, regardless if this contract went through or not, regardless of inspections. They wanted it done. So this is in the box number, you're going to put in this, the dollar amount under box 3 or paragraph 3, you're going to put the sales price amount for your client for their conventional loan. If it doesn't meet their sales price contracted amount, their full appraised value that they can walk, gives them an additional right to terminate, and the earnest money will be refunded to the buyer. Okay. You have any questions?
I don't know.
You have any questions for me?
No, good.
Kristen?
You're so good.
No.
So good. I mean, part of it, I'm like, oh, I get that. I've heard that. And then I'm like, what? It just, every time I get to sit into one of these contracts or documents classes, it just really is such a good reminder for me, how detailed the business of real estate is and how awesome it is that you guys get to help navigate through all of that.
People ask me, why is there so much in these contracts and why is there so many things? And so I told them, I said, because somewhere back up the line, there was a lawsuit.
Yes,
Mhm.
every single time, tell your client,
Mhm.
you know, my one contract is now 11 pages. Every single time someone's been sued. Well, that's what Trent tells us, right?
Mhm. There's a
Go back
reason
to
why
the VA.
disclaimers are what they are.
So VA is gonna be very similar to kind of like all the line items on there.
Sales minus down payment for the first one,
Mhm.
not less than however many years their loan is for, not to
Mhm.
exceed whatever their interest rate is unless it's fixed, right? That's
Yes,
the first, okay. However many years, if it's a fixed one, not to exceed blank percent of the loan,
for their origination charges, yes.
okay. So that's whatever percentage they're putting down,
Mhm.
right? Okay.
Now, and normally, I'm not saying that you won't have that, but now, hold on. Yes, technically, all of them are gonna be your sales price minus your down payment.
Mhm.
More than likely, VA buyers can, are 0% down,
Yeah.
but
that's
they
what confused me.
can put money down. One of the agents that I do her contracts for, when I'm putting in, like, in property base, I'm filling in the financed amount. I looked at this and I was like, wait, VA, like, cause I remember I just plugged in the sales price, knowing that it was VA, cause I'm looking at VA. So then in property base, you put in how much is the financed amount, which was lower than the sales price. I'm like, did I get that wrong? Let me go back and check. And sure enough, they were a VA buyer, but they wanted to put money down.
Yeah,
So yes, all of them are sales price minus down payment. VA, 99% of the time is gonna be the same price that loan amount is gonna be the same price as your sales price, but it might not always be the case. If they have additional cash, they can still put money down.
yeah, I think we ended up putting 20% down on ours.
Yes,
It just 'cause-
optionally,
Well, ours, the property didn't appraise either, so we had to come up with.
if you
the-
wanted it.
Yeah, we really wanted the property. Anyway, that's a long story too.
And then it also, the same thing, USDA is also a no money down loan program, but again,
Have you ever seen one of those?
Mhm.
You have?
I have not run one like a client of mine, but again, actually today, one of our agents had a USDA one that was zero money down. They were FHA, they have the seller, but their agent that they're working with, originally the contract came in FHA, and then they must have decided along the way, hey, this property, again, loan type goes to property approval.
Mhm.
This loan property is located in an area that is approved for USDA, and so they switched it to USDA and they chose not to put any money down, keep their down payment money.
Is USDA still basically loans outside of
Rural areas.
an incorporated area?
Yeah, and again, that's gonna be with your lender, they can run the address and see if it qualifies for USDA. That's it. Yay,
Thank you.
thanks.
Thank you, Becca.
Now we need to do a contract.
Those are always fun.
They are.